Hi there, I'm Tyler Ballhorn, and this is the Stockscores Market Minutes for February 25th, 2013. In this week's Market Minutes video, I'm going to show you how to find signs of market corrections and also how they can be profitable. We'll go through that in just a moment. A reminder to subscribe to this YouTube channel to get instant updates anytime a new video has been uploaded, and also to subscribe to my free weekly newsletter at stockscores.com/newsletters.asp. Now, because the market is showing some weakness this week, I thought I would talk about the signs of market corrections. You know, most investors despise market corrections, but they actually create a lot of opportunity, and I'll show you that in just a moment. Market corrections tend to come from trend line breaks after a falling top has formed, and that'll make a little more sense when we get into the charts in just a moment. Getting out of the market early allows you to be cast strong for the almost inevitable bounce back rally. The strongest rallies come from emotional market sell-offs. The bigger the correction, the better the opportunity. You know, great money was made after March of 2009. Great money was made after the crash in early 2000. So when you get these big emotional sell-offs, you also get great upward trends that come out of them because, of course, stocks get cheap when there are corrections. So let's look at some charts here. This is a chart of the S&P 500 going back over the last year, and I've circled in red the two major pullbacks in the market in what was otherwise a bull market over the last year. And you can see that both of those, each of them in a red box there, ended up leading into a strong market rally. The most recent one started in December and has continued up until essentially last week when the market has started to top out in the short term. Now, what I find is that the early stages of the bounce back for us on the most recent upward trend that was in December and then into January are the easiest times to make money. I was looking at my own trading records for the last few months, and I made my best profits in December. January was okay, and it's been pretty tough to make money in the month of February. Why? Well, we're well into the trend. The buyers are getting exhausted. What a correction does is it recharges buyer interest and allows the market to, for investors to find a good reason to come back into stocks. When stocks get cheaper, well, investors are more likely to want to buy them. They are on sale. Now let's take a look at the intraday chart of the S&P 500 going back last month. And what you'll notice here is that the market has just formed a falling top on this chart. Now, it broke the upward trend line on Thursday of last week. It rallied back into this morning and then formed a falling top this morning, and that is the classic sign of a correction or at least a pullback. If we go back to this chart, you can see that the corrections in May of 2012 and in November of 2012 were both preceded by a breakdown from a falling top. We had a falling top at the start of May, and we had two falling tops in October of last year, and that led to these breakdowns. Well, we've just had a falling top formed today. The high today is lower than the high set last week, and so we're setting up again for that market correction pattern. Right now, that's a basic overview of corrections. Let's get into some little bit more detailed analysis of the overall market so we can decide whether this correction is going to be significant or not. You can see here what I've drawn is a monthly chart going back to 1993 of the S&P 500. And the real problem for the market right now is we have rallied up to long-term resistance at the all-time highs. You can see that we've hit the highs set in 2000 and then again in 2007. You'd actually just fallen short on this rally, but it may be that we are setting up for that pullback that tends to come when the market hits highs. Are we going to get the same dramatic pullback that we got in 2000 or in 2008? There's really no sign of that yet. This is a monthly chart, and you can see I've drawn a little rising wedge pattern on the right side of this chart. We haven't broken down from that pattern yet. We may only just get stuck at resistance here for a little while and ultimately break through resistance. Or we may break that upward trend line, at which point we've got to get a little bit more worried. But that's the kind of thing that you want to watch for in these long-term charts. This is the chart of the TSX 60 ETF, and it doesn't look as bad as the S&P 500 chart, but it also hasn't performed as well as the S&P 500 chart. So there's a greater propensity for some profit taking in US stocks because that market has done better. The Canadian market has been lagging the US market and is really just in a flag pattern right now and really no sign of a significant technical breakdown. So I think this chart remains okay while the S&P 500 chart looks a little bit weak. Here's a chart of the Russell 2000 ETF, IWM is the symbol, and there you can see the upward trend line broken, the formation of a falling top, and that really sets up for a bit more of a pullback. Now, today's selling was a little bit emotional at the end of the day. It won't surprise me if we see a little bounce back in the next few days, but I do think looking out a week or two, we're probably going to be a little lower than where we are now and possibly a lot lower. And so we want to be pretty cautious with stocks until we can build a little bit of a rising bottom rather than this falling top. This is the chart of the Treasury Bond ETF, 20-year Treasury ETF, TLT is the symbol. And it's another cause for concern because money rushed back into bonds today and we broke the short-term downward trend line. Now, we're still below the long-term downward trend line. I've drawn that in red. It's the longer line in red. And so we may simply rally up to that. The buyers will get bored with the bond ETF and we'll see money start to come back out of bonds again. But in the short term, this is a sign that money is coming out of the market and looking for the safety of bonds. Now, one of the real major reasons why we're getting some selling pressure in the market and some buying pressure in treasuries is that the US dollar has been strong for the last month. A strong US dollar makes US stocks more expensive for the rest of the world and it makes them less desirable. And so we're seeing here a breakthrough, some resistance today on the US dollar. It's coming from a rally. That makes it more likely there will be profit taking in the short term. I do think that the US dollar is a little bit overbought in the short term. And so it won't surprise me if we get a little bit of a pullback in the US dollar, a little bit of a bounce back in stocks in the very near term. However, the damage is done. We've broken through resistance on the US dollar and we've broken down from a falling top on stocks, and that is a sign that we're going to be probably seeing a little bit more weakness in the short term here. The euro broke its upward trend line. Again, there is a reason here to be pessimistic about stocks because the euro tends to correlate with the S&P 500. Strong euro means a weak dollar, and we just talked about why that's important. And here we're seeing a weak euro, which may lead to a stronger dollar. So a little bit of cause for concern here as well. Gold has really been pummeled the last couple of weeks. It's oversold. You can see I've drawn the red downward trend line on the chart here, and it's way down below that. So that means in the short term, it may bounce back a little bit, but the fact is the sellers are in control. We do have falling tops here, and I wouldn't be surprised if we get a little bit of a short-term bounce in gold, but I don't want to be a gold bull right now until the pattern improves. Oil has also been selling off. Again, a function of the strong US dollar makes oil more expensive, and that hurts oil prices. We are in more or less a neutral to slightly negative long-term pattern on oil, and we're just sort of gyrating between the resistance at red line and the support at the green line. And so I think that oil probably drifts a little lower until it hits that green line and bounces. Not overly concerned about the price of oil here, but it looks like a bit of a dead market right now. Here's the important chart right now. Because we're seeing some volatility in the market again, we're seeing a pickup in activity in the VIX, which helps all of the ETFs that are centered around the VIX. This is the most liquid of them, the VXX. It broke through resistance today. It's been very volatile the last few days, and so I expect that this is going to be a good place to trade in the near term because fear is becoming a factor in the market again. Now, it I think got a little bit overblown to the upside today. Wouldn't be surprised if it pulls back in the next few days, but this is a chart I'm watching very closely for day and swing trades because there is action again in the VIX where there really hasn't been much over the last year at least. All right, so my ratings then, bearish on US stocks, neutral on Canadian, bearish on gold, but short-term bounce likely there, and bearish on oil, although I'm not too concerned about oil. The market is nervous and eager to sell on any negative news. A pullback is likely, and a correction is possible in US stocks. Canadian market has not yet suffered a negative breakdown, but could follow the US, so we want to be cautious there. Gold is weak but oversold, and oil is likely to be lower in the near term. Well, that has been the Stockscores Market Minutes for February 25th. Have a great week in the market and trade well.